if I look at last year, from November, Bitcoin rallied 62%, ETH 74, Sol 74, Sui 235%. The previous year, we had the same factor. All year, we did nothing, exploded the end of the year. Bitcoin 37%, ETH 40%, Solana 305, Sui 128. We're 7th of November. This is where it started last time. Who knows? But, from here, we should be significantly higher. My best guess is we will have full clarity by the end of next week. Now, whether they agree something soon, but the probabilities, the market will start finding traction. And then as it comes, it'll then start accelerating from it.
So you think we're going to hold 100K?
Yeah, and I think we will end the year a lot higher. Don't forget, last year, we didn't start rallying until November 7th. And then we did 64% from then.
The cryptocurrency market is locked in a deep freeze, with Bitcoin stuck at a massive price point. But this stagnation isn't a failure. It's a calculated, structural pause. The financial system hasn't run out of fuel. Its supply line has been deliberately cut, arming an imminent explosion. The core of the crisis lies in global liquidity. The invisible force that data proves controls nearly 90% of all price action. That critical flow vanished because the system was hit by a devastating 1-2 punch. First, the Treasury hoarded massive cash reserves, actively sucking liquidity out of the economy, while simultaneously, the Federal Reserve continued actively removing money through quantitative tightening. This combination choked the market, creating the intentional freeze. But this crisis is the setup. Popular macro expert Raoul sees this moment not as defeat, but as the final stage before a massive rally. He argues the explosion is now inevitable because the structural blockages are being reversed. The Fed is signaling a pivot and the need to expand its balance sheet, effectively restarting the money printer. Simultaneously, the Treasury must soon spend down its cash pile, rushing hundreds of billions back into the economy. Powell insists his predicted period of extreme growth, the banana zone, was merely delayed, not cancelled. History confirms this pattern. The market always feels utterly broken right before it rips higher. Given that the Fed is pivoting and the Treasury must spend, which mechanism, the restarting of the money printer or the $250 billion cash flood, will be the immediate trigger for the banana zone? Now, let's hear directly from Raoul for more insights on this issue. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
People are so impatient. They think banana needs to be immediate and needs to be in their precise bags. And that's the issue. We're at that point in the cycle where over time, the liquidity has to come to roll the debt. And as that comes, prices go exponential. And it won't be for everything. Obviously, there's too many tokens now. I don't know how many tokens there are. There's like 1 million of the things.
3 trillion, I think, is my reference.
Yeah. So generally speaking, it's going to be, I think the cycle got extended. It got extended because they increased the maturity of the US government debt from 4 years to 5 years, and that pushed the cycle out longer. And so that's why the business cycle has been subdued, like Main Street's not participating, but Wall Street has. And the moment that kind of changes, which all of our forward-looking indicators suggest, feels like bananas should be on the menu. It's a somewhat unusual environment. So the main driver of crypto prices, NASDAQ, everything is global liquidity. It's like the amount of money central banks create in the system, whether it's through the banking system itself or whether it's through other mechanisms like the QE or things like the Treasury General Account. So that is the liquidity. That explains 90% of all Bitcoin's price action, which is fascinating. The outperformance of alts versus Bitcoin is driven by the business cycle, the ISM survey. Once that goes above 50, people have more money. They start speculating, going further out the risk curve. So everything had been following the money, global M2 and global liquidity up until about July. Well, what happened in July was, firstly, the tariff thing started kind of kicking in and people were starting to get confused. But then what really happened is the Treasury began to build the Treasury General Account ahead of a government shutdown. So what that is, when they build it, they're basically not spending money out of their bank account. So it's less money going into the economy. And normally that's offset by what's called the reverse repo market that had been already drained. So there was no other liquidity to add because they were also doing quantitative tightening, i.e. taking money out of the system as well. So we had this double tightening going on. Okay, that was going to be a short period of time when they rebuilt the TGA, and then the government shut down. So now they can't even spend the money that's in there. There's like $1 trillion in the government account, and they can't spend it because all the workers have been furloughed. So that means that money doesn't go into the economy. The reverse repo is drained, so there's no other offset, and they had quantitative tightening. So suddenly liquidity starts seizing up in the system, and we start getting weird things going on. And so the Fed immediately said, we're going to stop QT. So that was at the margin, we're going to add liquidity. And then they've even recently today saying, you know what, we're going to have to expand the balance sheet to give the banks more reserves. So they're using the banks to increase the liquidity in the system. So now we're stuck still with them having a record amount of money that they need to spend. They need to spend $250 billion in 3 weeks or a month to pay everybody for their back pay. So that's all going to flood back into the system the moment the government reopens. And when it reopens, that's when liquidity comes back. They drain the TGA over time, but now they have a new liquidity measure, which is the ability to increase the balance sheet. And then the multiplier from the banks goes through. You know, it's quite funny because that libertarians say, well, I've not seen any difference with no government. Yeah, you have, because numbers gone down. We've all got poorer because liquidity has been drained out of the system. But they're structurally going to change this next year as well. They're implementing something called the SLR, the Strategic Lending Requirement, which allows them to allow the banks to keep more reserves, which means they'll buy more government bonds and allows them to lend more money. So they're trying to solve this problem over the longer term. So that's another mechanism by which we'll add liquidity next year that we didn't have this year. We really had a broken system this year because we only had the government which draws down its bank account, then builds it back up again. So it keeps going in cycles. We've always noticed this. We're like, why can't we have nice things? When the market gets to the high, it ends up coming back down again. It's because of this mechanism. But that should now be replaced going forwards. Generally speaking, the market will front run this. So we're still trying to decide when the government's going to reopen. My best guess is we will have full clarity by the end of next week. Now, whether they agree something soon, but the probabilities, the market will start finding traction. And then as it comes, it'll then start accelerating from it. We will end the year a lot higher. Don't forget, last year, we didn't start rallying until November 7th. And then we did 64% from then. Once you see that there's only one dominant factor, it actually is easier. You can strip out all of the noise, all the stuff people tell you about, you know, it's tariffs, it's this, it's geopolitics. It's none of it. It's all one factor, so 90% of it. Nothing is perfect. There's always wiggles. There's always things that change, like the shutdown is now the longest shutdown ever. You don't expect that. But when it comes, you kind of know what it's about and why it's stalling things. And again, to go back to the hopium zone, which is the most important part for all of us on a Friday, if I look at last year, from November, Bitcoin rallied 62%, ETH 74%, Sol 74%, SUI 235%. The previous year, we had the same factor. All year, we did nothing, exploded at the end of the year. Bitcoin 37%, ETH 40%, Solana 305%, SUI 128%. We're 7th of November. This is where it started last time. Who knows? But, you know, from here, we should be significantly higher.
Powell points to one dominant factor: global liquidity. When central banks create money, whether through quantitative easing or other mechanisms, risk assets such as Bitcoin and tech stocks tend to rise in value. When liquidity contracts, they fall. It's that simple, and Powell's data shows this relationship explains roughly 90% of Bitcoin's price movements. But something unusual happened this year. Starting in July, Bitcoin and the broader crypto market began to stall, despite liquidity conditions that should have supported higher prices. The reason, according to Powell, is the Treasury General Account. The government began hoarding cash ahead of a potential shutdown, withdrawing liquidity from the economy instead of spending it. At the same time, the reverse repo facility, which had been providing a cushion of extra liquidity, was completely drained. Additionally, the Federal Reserve continued quantitative tightening, removing even more money from circulation. The result was a double squeeze, less government spending and continued Fed tightening, with no offset mechanism to provide relief. Then came the government shutdown itself, freezing over $1 trillion that should have been flowing into the economy. Workers were sent home, spending stopped, and the liquidity that drives crypto prices simply disappeared.
So the exponential age thesis plays into all of this, right? The answer to this mess of demographics where global growth keeps falling because we've got aging populations, productivity goes down because old people are less productive, and debt growth is the other driver, and we reached that peak 2008. So how are we going to solve this? We're going to solve this by changing that population number by the robots and the AI. So that is coming, but that's only just started. So we've still got this everything code cycle to continue to play out, which is we have to refinance these debts because the debts are too big versus trend rate of GDP growth, i.e. there's not enough taxes to pay for it. So what they do is debase the currency to kind of make it go away. And they're doing that until the robots and the AI kick in. And we've heard that from Scott Bessent, we've heard it from Donald Trump, we've heard it from Elon Musk. It's like productivity has to pick up. And that's what it's going to come from. So that happens. My guess is we start to get a bizarre world where this starts to really affect economics by about 2030, 2032. Suddenly we'll see GDP growth accelerating, but unemployment might rise. We'll see AI agents as better investors than us. What does it mean for financial markets for us? We get to a point that I call the economic singularity. We have kind of the whole economic system as we know it breaks, and we have to develop a new one because somehow we need to tax the robots and the AI. How the hell do you do that? You know, people talk about universal basic income, but we need to solve who do we tax? Where do we get that money from? All of these issues. And then how do we deal with the fact, and this is the bigger thing, is people don't really realize is we're arguing over, do we have AGI or not? Artificial generalized intelligence. We currently have AI that is as smart as a PhD in every subject known to humanity. Right, so this is a polymath that's smarter than anybody on Earth. The next phase, because the intelligence of these models keeps like doubling every year, is we go from an IQ of like 150 to an IQ of 300. We have now replaced ourselves with the apex intelligence. The history of humanity, we have always been apex intelligence. And I have a thesis behind all of this that the fundamental purpose of the universe is essentially to convert units of energy into units of intelligence. And that's the whole evolutionary process. And what we've just created is a new superintelligence. And so we're not the apex creatures. So what does that mean for economies? What does it mean for us? What does it mean for our role in it? I'm not a doomer. I don't think this is the end. I think we just do things differently, which is about being human. It's actually not easy to bet on it cleanly outside of NVIDIA, and NVIDIA's dominance, like Bitcoin dominance over time, has to fall. So we need to see other players coming in. So where's the cleanest bet? Crypto's one of them. Why? Because in the interim, we have to debase currency. And also, agents will use crypto rails. So we kind of know where this is going. So that makes it a very easy bet. It's also been the fastest adoption of any technology or financialized technology the world's ever seen, because AI you can't directly invest in so easily. The other thing is I try and think where the world will go. So we can make plenty of money up into that economic singularity, whether it's out of crypto, buying tech stocks, number will go up over time. There will be a period where everything corrects, NASDAQ corrects 30%, but that's kind of noise within the overall trend. But what I'm thinking about is what about the other side of this? What has value? Now, I think crypto still has value in that because of its use cases and how it evolves. Things like digital ID become more important. That uses blockchain rails. But I also think about the value of digital art, because in a world where you're competing in financial markets with AGI, you have no chance. So what assets can you hold? Well, you want scarcity. So can it be a house? Yes, but houses have this demographic issues and other issues. We also have the movement out of cities into places. We have remote work, so we can move globally. But when I look at it, digital art is, if we're going to go from a $4 trillion asset class today in crypto to 100 trillion by, let's say, 2032, that's going to create 97 trillion of wealth. Let's halve that because I'm an idiot. So you still create $46 trillion of wealth. will have made it in crypto. So digital assets and digital scarcity is something that we all understand. And the culturally relevant marker stones of that are NFTs. Once you detrend Bitcoin, it's the exact chart, which is why we've had this weird sort of grind higher, but without the real exponential phase, is because the business cycle. And if you just think about it in sensible terms, is if the business cycle picks up, we all have more spending money, and then we invest more and we buy riskier things.
But Raoul Pal isn't worried. In fact, he sees this moment as the setup for something massive. The Fed has already announced it will stop quantitative tightening, adding liquidity at the margin. More importantly, officials are now saying they'll need to expand the balance sheet to give banks more reserves, essentially restarting the money printer. And once the government reopens, which Pal expects to happen soon, the Treasury will need to spend down its massive cash pile quickly. Workers will receive back pay, programs will resume, and roughly $250 billion will flood back into the economy in just weeks. Additionally, Pal highlights a forthcoming structural change in 2026, the Strategic Lending Requirements Reform, which will enable banks to hold more reserves and lend more money. This creates yet another mechanism for liquidity expansion that didn't exist during this cycle. In other words, the conditions that caused this year's stagnation are being systematically addressed, and the system is being rebuilt to provide more stable, ongoing liquidity going forward. Pal draws a direct comparison to previous cycles. Last year, Bitcoin did nothing until November 7th, then rallied 64% into year-end. The year before, the market was stagnant until it suddenly surged, with Solana experiencing a 300% increase. Both times, the market felt broken right before it ripped higher. And both times, the catalyst was the same: liquidity returning to the system. Looking at history, Pal believes we're sitting at the exact same inflection point. The government shutdown is creating fear and confusion, but once it resolves, the pent-up liquidity will rush back in. The Fed is pivoting, the Treasury will spend, and the market, which has been coiling under pressure for months, will finally have the fuel it needs to ignite. Pal's conviction extends beyond the short term. He believes we're still early in what he calls the exponential age, a period where artificial intelligence and robotics will drive productivity growth high enough to solve the demographic and debt problems plaguing the global economy. Until then, governments have no choice but to continue debasing currency, refinancing debt, and printing money to keep the system afloat. That creates a perfect environment for Bitcoin and crypto, which thrive in conditions of currency debasement and liquidity expansion. The banana zone, he insists, is still coming. It's just been delayed by a temporary liquidity crisis, by design. Now, do you actually think the government reopening could be the trigger that will finally unleash the crypto bull market? Thanks for watching, and don't forget to like and subscribe.